Just around 15 years ago, we experienced one of the worst banking crises in modern history. The S&P 500 fell roughly 50% from October 2007 to March 2009. U.S. house prices fell by 13.9%, with some regions experiencing 40 to 50% losses. And economic activity declined dramatically, with the U.S GDP fell by 4.3%, the largest decline since the Second World War. Financial institutions worldwide suffered severe damage, leading to an international banking crisis and large-scale bank bailouts in the U.S. In Iceland, all three of its largest banks went bankrupt, leading to the largest systemic banking collapse experienced by any country in history, relative to the size of its economy. You might wonder why governments around the world felt the need to bail out banks. Well, this is because banking is a special industry. A modern economy cannot exist without a functioning system for facilitating payments and providing loans, which allow the real economy to grow and expand. Of course, these very functions are what makes them fragile, as a shock in the banking industry may lead to wider economic collapse with disastrous consequences. So, let's start with the types of risks in banking, and there are three main risks that banks face. The first one is credit risk. When you lend money to someone, there's always a chance they won't pay you back. This is credit risk. Of course, banks have their way of reducing this risk. When you apply for a loan, for example, banks will look at your income, employment history, savings, whether you have valuable assets to use as collateral or not, credit score, spending habits, and many more. These assessments determine how much interest they'll charge you. If you are seen as a risky customer, your loan will get rejected or at least become more expensive, at least in theory. The second one is market risk. When you invested in something like shares of a company, it could drop in value and may very well become worthless. This is market risk. Investment banks in particular are prone to this as they tend to hold a lot of financial assets like stocks and bonds. In 2007, when the housing bubble burst, for example, investment banks were left holding trillions of dollars of worthless investments in subprime mortgages. The third one is operational risk. These include humans making bad decisions, software errors, frauds like corruption, insider trading on the bank's account, computer hacking, and so on. It's different from the two types of risks we've just learned, as it is intrinsic to the bank itself. But it's still one of the biggest risks that banks have to face. For example, U.S. banks that earn more than $10 million annually face up to 2,000 fraud cases per month. For every dollar lost to fraud, U.S. financial institutions saw a $4 increase in costs. Banks take on and manage this risk, and naturally some bankers are better at it than others. So there will always be occasional bank failures even in a healthy financial system. In fact, I would argue that isolated bank failures are a good thing, as they allow resource allocation from poorly managed and inefficient banks to more well-managed banks. The real problem begins when multiple banks fail at the same time, creating a failure in the whole system. This is what's called a systemic banking crisis. There isn't an official criterion of what is considered a systemic crisis, but when the capital of the banking system is almost wiped out, that's a systemic banking crisis. By this definition, some examples of systemic banking crises include the 1980s debt crisis in Latin America, the late 1980s banking crisis in Scandinavian countries, the early 1990s asset prices collapse in Japan leading to its lost decade, the 1997 Asian financial crisis, and of course, the global financial crisis of 2007 and 2008. And by the way, don't confuse banking crises with regular recessions. Only around 25% of recessions stem from banking crises, but according to this paper, recessions that came from banking crises are 40 to 60% deeper, last at least 1 year longer, and with wider effect, meaning that more people have to suffer because of it. So what are the main causes of systemic banking crises? The first one is a contagious bank run. It is when failures in one bank spread to other banks in the system as depositors all withdraw their money at the same time, even in healthy banks. When this happens, it pressures the bank's liquidity and forces the banks to sell its assets, possibly at fire sale prices, which may lead to bankruptcy. If not prevent the true policy, banking failures can become systemic and spread panic to the whole system. Depositor panics are most damaging when they result in contagion. with liquidity pressure spreading through the banking system as one bank failure spread to others through the interbank market. Just think of it as the banking system exclusively used by banks to transact with each other. A good example of a contagious bank run was during the Great Depression. In the fall of 1930, the US economy was recovering from the 1929 stock market crash, but a series of banking crises turned a normal recession into the Great Depression. One cause was the poor practice of counting checks. These checks were counted in the reserves of two banks, but in reality only one bank had the cash, so the banking system had fewer cash reserves than most bankers think. And when the panic happens, banks could not mobilize their reserves in time. Depositors rushed to withdraw their funds, the bank didn't have enough cash on hand, and it went bankrupt while the panic spread from town to town. During the Great Depression, around 40% of US banks failed in one of the largest banking crises ever. The problem with this view though is that traditional bank runs like these are quite rare, especially because deposits are insured in over 100 countries nowadays. So while the contagion is a possible way of creating a systemic banking crisis, it is rare to see a large-scale crisis caused by a contagious bank run. And in the Great Depression example that I've mentioned before, it is unclear whether the bank run was the cause of the depression or the effect of the depression. Sometimes it is hard to distinguish between the two. Another cause of a banking crisis stemmed from huge losses in the bank's asset values. These losses usually happen when an economy is booming, following periods of expansionary monetary and fiscal policy, and usually include some sort of deregulation in the financial sector. How this happens is that credit grows rapidly and investors became more optimistic while lending standards deteriorate. When the cycle peaked and economic conditions turned slow, investors began to move their assets to higher quality investments, and that causes a collapse. As a rule of thumb, the bigger the increase in asset values throughout the good years, the bigger the crisis. According to this view, a systemic banking crisis had its roots in asset bubbles. Overly expansionary monetary and fiscal policies spurred lending booms, excessive debt accumulation, and overinvestment, causing a decline in asset quality. This is especially dangerous for developing countries that often borrow money from abroad using foreign currency, as it can cause huge losses following a depreciation in the exchange rate or a rise in interest rates, which is a huge concern that the world is facing right now. For example, the Latin American debt crisis in the 1980s happened after a massive lending boom from international banks. In 1970, debt to Latin American countries was at $29 billion, and 8 years later it was at $159 billion, a rise of more than 700%. Mexico and Brazil accounted for $89 billion, more than half of the total debt in Latin America. When US interest rates rose rapidly, as former Fed Chairman Paul Volcker attempted to fight double-digit inflation, these countries find it increasingly harder to pay their debts. And in 1982, Mexico declared that it couldn't pay its debts, and soon, other nations like Brazil, Venezuela, and Argentina followed suit. Also, it didn't help that corruption was rampant in these four countries at the time. Financial liberalization and deregulation have also helped to fuel lending booms and banking crises, as the amount of credit available is an important indicator of asset prices. So, by expanding the volume of credit, it can lead to a bubble in asset prices, especially when banks do not observe the quality of the investments they fund. Moreover, as financial reforms lead to a more competitive market, we can expect an increase in the failure rates of banks. After all, banks will respond to higher competition and a shrinking customer base by charging lower rates on loans. With increasing competition, banks' funding costs may rise because they have to pay higher rates to attract deposits from competitors. As revenue decrease and costs increase, profit margins shrink. But if the government is reluctant to close down banks, this creates a moral hazard. As banks are pressured to increase their returns, they begin to invest in riskier assets. Expansionary monetary policy will manifest itself in higher asset prices, and bankers will be induced to double down on those risky investments to gain higher returns. For example, during the 1970s, banks in Norway, Sweden, and Finland were highly regulated, with restrictions on the interest rates they could pay to depositors and on the interest rate they could earn on loans. In this environment, With artificially low rates on both deposits and loans, they can only lend to the best possible customer. This might sound like a good thing, but it is highly inefficient and banks couldn't effectively play their role in the financial system. Moreover, banks don't have the skills to properly screen and monitor their borrowers because of the highly regulated system. During the 1980s, deregulation helped to cause lending booms and banks engaged in risky borrowing. And in the late 1980s, a collapse in real estate prices caused massive losses for the banks that ended in government bailouts. Now, the 2008 global financial crisis introduced some new elements, although the core theory stays the same. The credit boom and rising real estate prices are triggered by financial innovations in the form of asset securitization like mortgage-backed securities, government policies to increase home ownership, expansionary monetary policy, and weak regulation. The boom was exacerbated by a loophole in the system that allows banks to move assets off the balance sheet. Higher asset prices led to an increase in home values, which led to increases in debt. And the asset price boom was further fueled by risky lending practices that caused an explosion of subprime mortgage credit. When real estate prices fell and subprime borrowers defaulted on their loans, there was confusion among banks because losses were hard to locate thanks to all of that asset securitization. Meanwhile, banks began to lose confidence in one another. The panic intensified after the collapse of Lehman Brothers, and by 2008, the crisis had spread throughout the world from a collapse in international trade and decreasing real output. Iceland was one of the countries that were hit the hardest, and it has pretty much all of the risk and crisis elements that we've just mentioned. In the early 2000s, its three largest banks all multiplied in size due to a massive credit boom in the international markets. When the crisis hit, the disproportionately large banking system imploded. The currency's exchange rate fell by 30%, making debt more expensive and banks were unable to roll over their short-term debt. The stock market fell by more than 90% from its peak, and there was no credible lender of last resort that was able to inject cash into the system. And it led to the largest systemic banking collapse experienced by any country in history. So, what are the consequences of a banking crisis? Well, one of them is declining funds for investments. If banks are illiquid, they will be less willing to lend money to firms and consumers, while also increasing the cost of borrowing. The higher cost and reduced availability of credit will depress the economy by lowering aggregate demand. For firms that got hit hard, they have to lay off workers and tighten their belt to survive, which will reduce demand even more as unemployed people will spend less money. In general, sectors that are more dependent on external financing will suffer more during a banking crisis due to the reduced availability of loans. A failure in one bank will also generate negative effects on other banks, in the form of a loss of confidence in the stability of the financial system, losses from the interbank exposure to failed banks, and losses from the failing banks' assets that they're forced to sell. This is different than in other industries, where businesses will gain if their competitors go bankrupt. And this is also why banks must be regulated differently from other industries. Banking crises often have important wealth distribution consequences, as government attempts to save the financial sector usually include wealth transfers from taxpayers to banks and from savers to creditors, while also providing debt relief through something like inflation or financial repression. I talk about this in depth in my video about how to solve a debt crisis. The real cause of banking crises can be measured in output losses, increasing unemployment, fiscal costs, and increasing public debt. According to this IMF working paper, the average banking crisis since 1970 cost taxpayers a staggering 13.1% of GDP, average output losses at 33.7% of GDP, and an average increase in public debt of 26.2% of GDP. Because banks play a crucial role in the economy, an important question is how much should the government intervene to prevent and solve a banking crisis. It seems that there is a trade-off between growth and financial stability. Financial liberalization and deregulation can significantly increase growth by ensuring the free flow of capital, but they made a country more susceptible to a financial crisis. Meanwhile, a highly regulated system is probably a stable system, assuming that regulators are good at their jobs, but the economy won't really grow much. This is an issue that every policymaker has to face. Now, another great case of a severe financial crisis is Japan's asset bubble in the 1980s, which led to its lost decade and third years of economic stagnation. I have made a full breakdown on that topic, so feel free to check that out. This is Doverhill, and see you next time.